Imagine this. You're a small investor in Paris in 1913. Every month you save a little, then bring it to the bank. The banker smiles warmly and puts a glossy printed document in front of you. Russian Imperial Bond, guaranteed by the Russian Empire, backed by gold, attractive interest rate, safety for your family's future. You hear Russian Empire and immediately think of a vast power. Endless land, oil, coal, metals, millions of peasants, a massive army, an ancient royal family. Who could possibly imagine that an empire like that could? Default? You sign, buy the bond, take it home, lock it in the safe. That night, you tell your wife, "Don't worry, this is the safest investment in Europe." An empire that's lasted for centuries can't collapse just because of money. A few years later, the Tsar's portrait on the bank's wall disappears. The bond in your safe becomes scrap paper. The empire you believed was the safest in Europe vanishes from the map, and people call it a revolution. But in the language of financial history, there's another story. Behind the revolution was a bond crisis, a collapse of financial confidence. That's why the title of this video is How One Bond Default Toppled an Empire. The financial secret behind the fall of Tsarist Russia. To understand how a default can push an empire into its grave, we have to go back to the beginning. The Russian Empire wasn't just a military giant, it was a massive debtor. Throughout the 19th century, Tsarist Russia was one of the biggest borrowers in Europe. The country was huge, the population large, but the state budget was weak and the tax system backward. To industrialize, build railways, arm its military, Russia needed something the West had and it didn't: capital. The solution was very modern: issue bonds on international markets. The most important hub was Paris. The French middle class, teachers, civil servants, retirees, loved buying Russian bonds. French banks promoted them aggressively. High interest, backed by gold, guaranteed by the Russian government. A safer foundation than a simple bank deposit. For years, it seemed true. Russia paid interest regularly. Railway projects, mines, heavy industry sprang up. The bond with the Tsar as signature and imperial seal became a symbol of safe yield in the minds of French savers. But beneath the surface, this model had a fatal hole. The Russian Empire's survival was increasingly tied to foreign creditors' trust. Taxes were insufficient. The economy was still largely agrarian, yet spending on the military, bureaucracy, the royal court, and wars kept rising. Each solution was another tranche of bonds. A huge empire was being turned into a highly leveraged borrower on the European capital markets. As long as investors believed and kept buying, the empire stayed afloat. But if that belief broke, the story would change completely. The first real turning point was a war Russia never expected to lose: the Russo-Japanese War of 1904–1905. Russia saw itself as a major European power. Japan had only been industrializing for a few decades. In the minds of the Russian elite, this was supposed to be a simple lesson in the Far East. Instead, the war was expensive, drawn out, and Russia lost. Losing on the battlefield is one thing. Losing on the balance sheet is another. War blew the already weak budget apart. To keep going, Russia had to borrow more, issuing more bonds. This time, at higher interest rates. Investors started whispering, "Can Russia really pay this back?" At the same time, the revolution of 1905 erupted. Uprisings, strikes, peasant revolts. The Tsar was forced to concede, create a Duma, parliament, reforms. But the core power structure didn't change. Spending still swelled. Reforms were half-hearted. Debt kept climbing. For investors, the signals were clear: political instability rising, borrowing needs increasing, weak ability to reform state finances. But because the yields were attractive, and because people believed a great empire cannot default, money kept flowing into Russian bonds. Then in 1914, World War I exploded. For ordinary people, it was a war for honor and allies. For the treasury, it was a nightmare. Russia mobilized millions of soldiers, bought weapons, shells, food. Military expenditures soared to unprecedented levels. Taxes couldn't rise nearly fast enough. The economy couldn't produce enough. And once again, the Russian government did what every cash-strapped empire does: borrow and print. Foreign war loans became a matter of survival. Russian bonds were pushed across Europe, especially in France, Russia's key ally. The debt burden swelled. At the same time, inside Russia, the government printed more paper money and effectively abandoned the old gold convertibility. In wartime, many people closed their eyes to the risk. The Russian Empire, with its huge army, was still seen as a pillar of the Allied front. The idea that Russia might default still felt far off. But financial markets aren't sentimental. Interest rates crept higher, discounts deepened, rumors multiplied. Even before the front collapsed, financial confidence was already cracking. By 1916, things were critical. The Russian army was taking massive losses. The home front was suffering shortages, transport breakdowns, rising prices. Inflation surged. The ruble weakened on foreign exchange markets. Russian bonds dropped in price on the Paris bourse. Some sharper investors started to dump them. They no longer saw Russian bonds as safe assets, but as ticking time bombs. Every bank review, every financial report, contained the same question. If Russia loses, who pays the debt? Inside Russia, people weren't using terms like default. They just knew. Wages didn't cover basic needs. Bread prices kept rising. Goods were scarce. The money in their hands was steadily losing meaning. But in the world of international finance, one phrase started to circulate more often. The Russians may not be able to meet their obligations. The Russians might not be able to pay. By early 1917, public finances and society had hit their limit. War debts were enormous. Budget deficits were gaping. The central bank was printing money to plug the holes. The ruble had plummeted. On the exchanges, Russian bonds traded at deep discounts, reflecting an uncomfortable truth. The market no longer believed that the Russian Empire was too big to default. Then, in February-March 1917, everything blew up. Petrograd, St. Petersburg, erupted into protests. Workers struck, soldiers mutinied, elites abandoned the Tsar. In just a few days, a centuries-old power system collapsed. Tsar Nicholas II abdicated. The Russian Empire was over. If you only look through a political lens, you call it revolution. But if you add a financial lens, you see something else. A collective, global loss of faith by the empire's creditors. When a regime falls, who pays the bills? Will the new regime honor the old obligations or say, that's not our problem? Are bonds with the Tsar's signature still valid if the Tsar is gone? The provisional government that followed tried to keep up appearances, at least on paper. They pledged to continue the war and to keep paying. But the economy was shattered, inflation was soaring, and the people were sick of both war and debt. The machine that had been running was out of fuel. Then, in October 1917, came another rupture. The Bolsheviks seized power. This time, any illusion of safe Russian bonds died. The new Soviet state looked at the mountain of Tsarist debt, owed mostly to foreign bondholders, and made a cold, logical decision from their perspective: repudiate all imperial debt. With a single declaration, we do not recognize the obligations of the old regime. Millions of bondholders in France, Britain, Belgium, and beyond saw their safe assets turn into wastepaper. Here is where One Bond Default Toppled an Empire becomes financially explicit. In reality, the Russian Empire had died months earlier. But in financial terms, the default on foreign bondholders was the official gravestone. The old system was dead and would not pay a single ruble on its promises. It's easy to think, that's just a foreign investor problem. What does it have to do with ordinary Russians? In truth, the two worlds were tightly connected. Because for many years before the collapse, the survival of the Russian Empire had been wired into the faith of international investors. Foreign debt allowed Russia to postpone reforms, postpone modernizing its tax system, postpone cutting wasteful spending. Whenever trouble arose, instead of facing it, the regime borrowed. Each new bond sale bought a little more stability with future obligations. By the time the confidence dried up, the empire had no financial cushion left. It could no longer borrow. It couldn't just keep printing. Inflation and currency collapse were already severe. It couldn't raise enough revenue. The population was exhausted. In that situation, political revolution was just a spark to a powder keg built by decades of financial choices. The protesters on the streets didn't need to read debt reports. They just knew. Wages were worthless, bread was expensive, the war was pointless. But the deeper reason sat in bond markets. The world had quietly looked at the regime and concluded they will not be able to pay. And when the new state finally made non-payment official, everyone looked back and thought, yes, the empire was already dead, long before the default was announced. From the perspective of financial history, the story of one default toppling an empire offers some brutally clear lessons. First, empires borrow like corporations, and corporations can go bankrupt. We tend to see states, especially empires, as immortal. But in bond markets, a government is just a very large borrower. It gets credit ratings, pays interest, and depends on lender confidence. When lenders lose faith, they pull back, demand higher yields, impose harsher conditions. If the government can't handle it, it defaults. The only difference is that when a firm fails, it closes. When an empire goes bankrupt, the regime is replaced. Second, war plus debt plus lack of reform equals a destruction formula. The Tsars lost to Japan, plunged into World War I, all while standing on a weak fiscal foundation with a backward tax system and rampant corruption. Instead of deep financial reforms, they reached for painkillers, foreign borrowing. Just like many states later on, instead of telling their people, "We can't afford this," they said, "We'll borrow and sort it out later." Later turned out to be 1917, 1918. Third, international investors aren't just victims. They help sustain fragile regimes. Russian bonds were once seen as safe. Banks, brokers, and newspapers marketed them enthusiastically, often downplaying political risk. The result? A weak regime was propped up with financial oxygen for years, extending its life, but also extending the period over which public anger could build. When everything finally collapsed, bondholders lost money, the empire lost power, and the people lost faith. But we must remember, for many years before that, it was international capital that allowed the system to dodge tough choices. Fourth, default isn't just about money. It's the collapse of a promise. A bond is a promise. We will pay you in the future. When a state defaults, it's not just capital that's destroyed. Trust in the entire architecture of promises takes a hit. In Russia's case, the break was extreme. Not just rescheduling or restructuring, but outright refusal. We do not recognize the debts of the old regime. Legally, that was a way to cut ties with the past. Historically, it was the final punctuation mark on a political financial order. And the last lesson, behind every revolutionary slogan, there's a balance sheet. We usually tell the story of Tsarist Russia's fall with powerful images. Hungry crowds, soldiers, red flags, the Winter Palace. But if you add a second layer of analysis, you see numbers, bond yields, exchange rates, budget deficits, repayment schedules, and finally a cold line of text. No payment. An empire doesn't die in a single mythical moment. It dies through each bond issuance, each delayed reform, each political decision built on the assumption that someone will always be willing to lend us more. Until one day, no one is. For the protesters, that day is revolution. For historians, it's regime collapse. For financiers, it's sovereign default. For us, looking back, it's a reminder that a single bond certificate can tell the whole story of how an empire went from power to nothing.